Hi, and welcome back to Elements in Focus. My name is Grant Soliven, Manager of Advisor Operations, and with me today, Aaron Rheaume, Director of Financial Planning. Aaron, thank you for being here, my friend. How are you doing today?
You're very welcome. And as always, I'm grateful to be here and happy to do these recordings with you.
Oh, and I'm happy you are too. And folks, today we've got a really special event. This is going to be like the usual Elements in Focus that some of you are used to watching, because Aaron and I are going to spend quite a bit of time talking about year-end tax planning. And if you're watching this, the year end is upon us. And we really wanted to ensure that you have tools and stories to be armed with to take advantage of what's coming and to give you action to move forward in your own tax plan. For those of you that are new to what Aaron and I do, we try to focus on 5 critical areas of financial planning that we can give you golden nuggets that you can put into your plan so you're not finding yourself in one of these areas falling into a trap and having your financial freedom be jeopardized because of a small mistake. And so today, again, we're focused on the tax planning piece. And something key that we want everyone to remember is there's a difference between tax planning and tax reporting. Aaron, can you tell us what the difference is?
Absolutely. Tax planning is doing things proactive that can affect your tax return prior to year end. So when the clock strikes midnight on December 31st, your tax planning ends for that year. Tax preparation is taking all of the tax planning that you've done throughout the year and actually putting that together and reporting it to the IRS. So getting your 1099s in order, capital gains, contributions to IRAs, Roth IRAs, all of that stuff, it has to be reported the following year. The planning is making sure that it's done prior to year end so that you can report it the following year. Huge difference between tax planning. That's where you're very proactive, making sure what you need to get done is done. The reporting part is the following year. And Grant, one of the things that we have found is we work with a lot of families and there's stories to tell. And so one of the things we're going to talk about today is playing chess with the IRS.
Absolutely.
How do we do that?
Absolutely. And it goes back to what you said, Aaron, about tax planning. A lot of families believe that we just do the report, we stick it in a drawer, we cry about how much tax we have to pay, and then we just rinse and repeat, right?
Yeah.
That's what Congress would love for you to do, okay? But tax planning is the gift we've been given from the IRS and from Congress to get ahead of some of these things that we have to report. So when Aaron, we talk about playing chess with the IRS, there are rules to the game. And if you know those rules, then you can play efficiently and well. Most people believe there's 2 tax codes, for the rich and for the poor. That's what media would love for you to believe. The actual tax code is not for rich and poor, it's for the informed and uninformed. So it's our job to work with our families to make sure that they're informed, so they're playing the right chess game with the IRS. And here's an example. I work with a wonderful family. All the families I work for are incredible. This one in particular strikes me because we are playing a pretty sophisticated chess game with the IRS. And what I mean by that is we are using 3 generations of tax returns to plan ahead of time. So every year they go to report, we've done everything we can to make sure their tax situation is incredibly efficient. So what does that look like? For example, the first generation, the family that came to us initially, they're trying to figure out a way to transition their estate and their legacy positions and IRAs, etc., to the next 2 generations. Efficiently. Because the original plan was to, hey, we're going to pass away, we have this trust, it's going to move all on, we're okay with that. And our team sat back and said, wait a second. There's a couple things that could end, potentially, that could wreck this entire plan. Number 1, the step up in cost basis. So for those of you who are watching and don't know what that is, cost basis is a definition. It essentially means the position, the value of which you bought at a certain point in time. So for example, if you're going to buy a stock and you bought that position for $100, that is the basis. And anything over that, say growth is $100, that's growth. And most of the time in a non-IRA asset that's not an annuity contract, which we can get into in a different time, that is taxed at capital gains rates, okay? Now, there's a rule currently in place that states that if you pass a position that you've bought in a non-IRA and you paid $100 for it, and it's now worth $200, and you pass away, that entire position, the entire $200 becomes stepped up in basis, and now the receiver, the heir of that money, will pay zero income tax.
Capital gains tax.
I'm sorry, thank you, capital gains tax. And it's a beautiful thing. Here's the problem. Currently, it is on the radar for removal. Congress has been trying to get rid of this thing every year since the 70s. And unfortunately, every year they put it on the table, it gets closer and closer to being removed. And so our job is to, okay, let's assume this rule stays in place, but at the same time, what are some things we can do to transition this asset and pay as little income tax as humanly possible across 3 generations? Because 2 of the generations have 0 to no income, which if you know your tax code well enough, if you have no income and you sell a capital asset, you pay 0 federal percent income tax.
As long as you stay in that 12% tax bracket or below.
That is correct. And so there are things that you can do. So you can imagine that we are essentially having the asset transition and recognizing it within that second tax bracket, 12%, 15% when the tax code sunsets, potentially, and no one's paying federal income tax. So we're getting the best of both worlds while the generation is still here, but here's the best part. They're now actually seeing not only the tax savings in case we lose something because of Congress, but they're gifting money to their heirs while they're here. And they get to see their heirs enjoy and use the money while they're still alive. So playing chess with the IRS can have a massive effect on taxes and on planning, but you've got to do what Aaron talked about. You have to plan and not just wait to report. But here's something that's interesting. Let's say you miss something in planning and you go to reporting, right? Does it mean that all of a sudden you can't go back? Well, this is the reason why you need to hire a planner, and specifically a tax planner. I'm not saying that CPAs are not tax planners, some of them are. But most of the time, Aaron, their job is to have you pay as little tax as possible, and they're helping you with the reporting. When you hire an effective tax planner, however, there are things that you can catch and potentially unwind. Aaron, why don't you walk through a story that you actually recently just dealt with, ended up saving the family quite a few thousands of dollars.
Yeah, Grant, thank you for the lead in, and thank you for going over the basis point. That is very critical. And as Grant said, we do like to look at all generations' tax returns. And playing chess with the IRS is not just looking at capital gains. It can be a multitude of things. And so there's not just one piece you're moving.
Correct.
You could be moving several. So one of the situations that I ran across with some of my other teammates a few weeks ago was diving into a tax return. And so many of you FEG families know that we do tax planning in the last quarter of the year. So we get all of our family updates in the first 9 months, we try to, and then that last quarter is specifically left for making sure we're doing efficient and effective tax planning. And so when we were reviewing the tax return, we were looking at where all of the income came from. And so you can look at W-2 wage, pension, Social Security, and there was other income reported on this. And so we were trying to figure out where this came from. And so the tax return always tells the story. And so as you pull apart some of the pages, you can go and find where that information is listed. And so we found out that it came from a K1, so a specific investment that was reporting a K1 income. Come to find out, the income was held inside of an IRA account. And for those of you that know, IRAs are tax deferred until you actually take money out of the IRA. In this case, it wasn't taken out, it was paid back into the IRA, and it was reported on the return as income. And so that was a $15,000 income being reported, Grant. And when you look at it, the individual, the couple, they're in the 24% tax bracket federally, married filing jointly, and 5% here for the state of Indiana. Not all of your dollars are taxed at 24%. You go, 10, 12, 22, and then 24. So your effective rate or your average rate might have been 20%. And so looking at that $15,000 of income going on the return, that was a couple thousand or a few $1,000 mistake that has to be corrected. And so they're going to amend their return. They'll be able to pay about $2,000 to $3,000 less in tax. We can offset that by doing Roth conversions. And where I want to leave you guys is if you are not working with someone that reviews your tax return, if they don't ask for your tax return during your updates or the meetings with your advisors, then they're not efficiently and effectively helping you do financial planning. Taxes are one of the most important things to pay attention to and can really pay dividends if you do the right and proper planning. As we're recording this video, it is getting towards year end. One of the things that we've been hyper focused on here in 2022 is making sure that we're doing IRA to Roth IRA conversions if it makes sense. And so let's just walk through a quick example. Let's say as a married couple, you have $4,000 a month that you need to meet your standard of living. So that's $48,000 a year coming in as income that you need to make sure that you're paying the bills, taking a trip, or whatever it may be. And so that income can be made up of Social Security, it could be pensions. Let's say it's all taken care of by Social Security and pensions. So you've got $4,000 a month coming in to pay that $4,000 a month standard of living. Well, married filing jointly, you get a standard deduction of about $28,000. So that's money taken right off that return. So now your 48 becomes 20,000. And what we want to look at is where can we efficiently move money around inside of a tax bracket? Well, we know in 2025, the tax code today sunsets and rates are going up. So in this situation, you could be in the 10 to 12% tax bracket, and there's about a $60,000 window that you could move money from an IRA to a Roth IRA, pay the tax now that avoids future RMDs. It avoids, hopefully, the widower's penalty. So if something does happen to you, those brackets get compressed in half. So now you're not married filing jointly. You're filing as a single individual, and the top of the 12% tax bracket just got cut in half. So it goes from 83,000 married filing jointly down to about 40,000, and you still have those mailbox checks that are coming in future RMDs. We have to get ahead of that. You have to start paying attention to your tax planning. And Grant, if they really want to know more or get a better grasp on some of the things that we do, how do they get a hold of us?
Absolutely. So if you're kind of spending time with us today and learning more about this, and you're finding value in what we're saying, and you don't have a team that's looking at your tax plan year in and year out and evaluating what changes need to happen to make sure you're doing things efficiently, please call us. 800-928-4001. One of our amazing team members will set you up with our effective tax planning team, one of our advisors, and they'll help walk you through your situation and build a plan that we can execute going forward. If you're looking for more content that we've produced on these subjects and other subjects, you can find that at our website, yourlifeafterwork.com. And if you have a specific question that our team can answer, please shoot us an email. Talk to FEG@yourlifeafterwork.com. And folks, we hope you found value in what we're trying to say today. We're trying to kind of give examples and stories that will help ignite the passion to get tax planning done so you're not leaving money on the table, and also so Uncle Sam is not the biggest benefactor of what you've worked so hard to protect. If you're having conversations with friends and family around the water cooler over the holidays and they're concerned about tax planning, please send them this video so they know what to pay attention to and so they know who to contact to help them work through this plan. So Aaron, any final comments before we go?
Yeah, I just want to leave you all with one last comment. I say this all the time. You all are unique. Your situation's unique. Your lifestyle's unique. When Grant and I are talking about this, we're talking in hypothetical situations. And so don't try to plug what we're saying into your situation. Please reach out to us so that we can efficiently and effectively plan and help you through your unique situation. Thank you for watching, and please share this with family and friends.
Have a great one, my friends. We'll see you next time.